So let's take a look at the 18.6-year real estate cycle and the UK's house prices. So if we take the most recent one of 2007 and 2008, the world-renowned housing crisis, and we go back 18.6 years, it coincidentally takes us back to the exact same time that house prices peaked before in 1989. And if we project this date forward, we get the 2025 to 2026 period. And you can see the same with America's housing markets. However, their 1989 drawdown wasn't as significant as the UK's. Nevertheless, they had their recessions around the same sort of time, and of course the 2007 housing crisis was dramatic. They also lost about 20%. So with this in mind, another interesting concept is whenever the year-on-year growth of property in London and the UK falls below the 0% line or loses value year on year, and it coincides with the 18.6-year cycle, every single time this has happened, this also gives us a great indicator as to when house prices are going to crash and fall over. As you can see here, in September 89 and July 2008. Recognizing the correlation between wealth and land provides us with a more accurate gauge of when indices reach their peak. When land prices soar, a cascade of consequences ensues. Rent surges, consumer spending contracts, and housing development businesses decelerate as the exorbitant land costs render their operations less financially viable. Drawn from our understanding of the cyclical nature of reality, akin to a pendulum, it becomes apparent that what experiences an ascent will inevitably undergo a descent, and what expands will contract. Nothing goes up in a straight line. The markets breathe. They breathe in, they breathe out, so on and so forth. They always are expanding and contracting. So with this in mind, home builders gives us early indications which can be confirmed by watching the yield curve and what the Federal Reserve do with interest rates, because home builders essentially speculate with land and build properties and homes for people to live or work in. And once land becomes too expensive, their business no longer becomes viable because it's no longer profitable. Therefore, they cut back on building. So home builders give us that early indication that the economy is slowing down. There's too much money in circulation and everybody's in on the party. Unfortunately, not everyone can be a winner. So this is the point where that bubble eventually bursts. Sure, it may be early. However, like I said, it's a great early indicator. And for those that don't know, the Fed are responsible for keeping the party going. Their main goal is to keep the economy expanding whilst combating inflation and the debasement of the dollar. So when money is too easy to come by, the Federal Reserve will raise interest rates to slow down the economy and combat inflation. Because if there is more money in circulation and the same amount of products, people will naturally pay more for that product because their money is worth less. So to do this, they need to raise the cost of borrowing money to be higher than inflation. Let's say your groceries are rising at 2% a year. The cost of borrowing money should be above 2%. As you can see from this chart, the Federal Reserve has never combated inflation until the central bank's rate has been above core CPI, which they've done recently. So going back to the charts, if we use strategies like the Dow theory, you could say the first warning sign was in May 2006. And this is where I believe Michael Burry started to short the housing market. Because if you look at the yield curve, I'll pull that out for you now. May 2006. From this point, the yield curve had inverted and uninverted. And when the uninversion happens, this is when we typically see the rollover in house prices. However, this time he was slightly early, uninverted again. So how could he prevented this, or had a more accurate analysis? If we look at the Fed funding rate as well, the federal funding rate is closely correlated with the yield curve. And if you don't understand why, we can delve into this in a future video as well. So we add on the federal funding rate onto home builders, it will give us a more accurate reading. And what typically happens between the time the Federal Reserve pulls rates and when they pivot, we see the stock market increase in value and speculations run rampant, because the time they paused was July 2006. And if we go back to July 2006, as you can see, between there and the peak, it was about a 20% increase. And what typically happens when the Federal Reserve cut interest rates, they're not doing it from the good of their heart. They do it because something broke in the economy and they need to support the economy again by making money cheaper to borrow, so more people will push money back into things by stimulating it all over again. However, by the time they cut rates, the damage has already been done. So between the time of July 2007, if you look at land registry, sure, it took about a year for house prices to roll over. Nevertheless, this was a good time to start getting out of the market, or at least stop aggressively investing. If we look at the Fed's funding rate and every time they cut rates, you can see this also coincides with the time real estate prices topped. Of course, it happened multiple times in between, and these are considered our mid-cycle recessions. So these mid-cycle recessions are generally great opportunities to capitalize on, because you still have another 7, potentially 9 years of house prices to continue in the uptrend. As of recently, although the Federal Reserve haven't necessarily said it, the hypothetical Fed pause has already begun. This time looks slightly different because generally when the Fed pulls, the stock market and everything alongside it starts to rally. So this is an interesting concept, and maybe too much damage was done during the pandemic because we did see astronomical returns. Just before we wrap up this particular video, I'm going to try and keep these as short as possible. The previous Fed pauses, we typically do see rallies from this point onwards. And of course, you can argue we recently have made a rally, which was slightly delayed. However, I will dive into this most recent rally in the next video. In 2008, you saw a 26% rally in the stock market. In 2019 to 2020, before the pandemic, was 40%. And sure, if you take the low here, you can say we rallied 9% as current. I realize this is one of the first videos I have done. If there's anything you didn't understand and you would like me to go into more depth about, be sure to let me know in the comments. If there is anything in particular you want to know more about, be sure to share that as well. So to wrap this one up, if you have a residential home in central London that you are looking to liquidate, or you're looking to invest in property in London and the surrounding areas, including Kent, Surrey and Essex, and you're possibly confused about the current situations and you would like a consultation, be sure to go on the website, which I will link below, and fill in the form, and we will get back to you at our earliest convenience.